It's Gerry Hart here, and today we're going to look at developments in the infamous IR35 saga. Now, there have been hopes in recent times that there would be a major relaxation of the implementation of IR35. Unfortunately, that's all but disappeared. All the Revenue have done in response to criticism from the House of Lords Select Committee is to amend their guidance on IR35 in a revised version published on the 17th of June. Having said that, and as we'll see in a minute, there are some useful new facilities now available from that particular publication. But the possibility of IR35 disappearing, which had been mooted by certain people, that really is just a pipe dream. Never going to happen. Let's have a look at the findings of the House of Lords Select Committees. Some of them are pretty obvious ones, I have to say, others not so obvious. So looking at the key initial concerns, the findings and other points made by the Select Committee, let's have a look at them. First of all, compliance with IR35 demanded a great deal of time and effort. I don't think anyone would disagree with that statement. HMRC were trying to apply an outdated method of taxation to a new emerging way of working. That's probably accurate as well. The abolition of IR35, although the committee said it would be attractive, would be unwise providing the amounts of tax that the Revenue insist are at risk were accurate. What the Revenue claim is that if you abolished IR35, tax at risk would total £550 million. But that, the committee said, was suspect, as it is based on estimates and needed more robust work to establish how accurate the estimates are. They also made the point that the current structure and rates of income tax and national insurance contributions, they clearly provide an incentive for taxpayers to arrange their financial affairs in order to minimise the amount of tax and NICs paid, which has led to complex legislation such as IR35. Again, I'm sure we'll agree with that. In the committee's view, the government should re-examine the longer-term case for combining taxes on income and NICs. They also made the point that the questions asked about personal service companies, which is what IR35 is all about, on the self-assessment tax return on the actual form, SA 100, were a missed opportunity to raise awareness of the potential tax consequences of operating through a PSC, and in many cases weren't answered by taxpayers. And then they said the Revenue were not allocating enough resources sufficient to ensure compliance with IR35. This meant, they said, that IR35 wasn't operating as a sufficient and effective deterrent, and also that many taxpayers were taking a risk and ignoring the legislation. They also finally said that there was insufficient guidance provided by the Revenue for those operating through personal service companies, although the introduction of the business entity tests and also the establishment of the IR35 forum, which brings together people from both sides of the fence, had improved matters. Well, what the Revenue came up with in fresh guidance on the 17th of June, somewhat inelegantly, is called Intermediaries Legislation IR35, working through an intermediary such as a personal service company. Now, this is a 19-page guide. Much of it covers how to calculate and pay the liabilities when IR35 does apply. But there are some new aspects which are useful to know. As follows: the Revenue operate a free and confidential IR35 helpline and contract review service. Conversations, they assure us, are confidential and you can keep your identity secret. Any information, they assure us, that they get isn't shared with the Revenue compliance teams. But the contract review service can only look at existing contracts, not planned contracts. The Revenue provide a unique reference number if they decide the contract is outside IR35 by what they call a risk-based approach, and that reference number is valid for 3 years, subject to any changes in circumstances that may take place. So in other words, if the Revenue come knocking on the door and suggest IR35 might be relevant, and you've already gone through the contract review service and they're happy with that, you can quote that unique reference number. Before seeing whether IR35 applies to a contract, they suggest you should consider the agency legislation and the managed service company legislation because they take precedence. Consider also, they say, using the business entity tests, which should indicate whether the client should be risk assessed as low risk, medium risk or high risk. If those tests indicate that the low risk band applies, this can help in the event of an inquiry. But you should retain your evidence of that test result because it is not automatically searchable. Keep a hard copy Keep it on your system and you should be okay. Let's look at these business entity tests then. 12 of them, very subjective in terms of what the tests are and the score. What you should try to do to get low risk assessment is score more than 20 points. So first of all, of the 12 tests, number 1, and they're not in any order of priority, business premises test. Does the business own or rent business premises separately from the contractor's home or separately from the end client's premises? If you can say yes to that, then it looks very much, doesn't it, as if this is a genuine business having been set up, and you score 10 points. You're halfway there. Professional indemnity test. Does the contractor, they call IR35 people contractors, whatever type of industry or profession they're in, does the contractor need PII? If the answer is yes, 2 points. Efficiency test. Has the business had the opportunity in the past 2 years to increase its revenue by working more efficiently? That's well worth considering carefully, because if you can say yes, it's 10 points. No, there's no degree of it. So if the efficiency test, you have had the opportunity to increase your revenue by working more efficiently, if it's not a particularly big aspect, you still get 10 points. It's all or nothing, basically. Assistance test is number 4. Does the business employ any workers who bring in at least 25% of the yearly turnover? If you can say yes to that, a whopping 35 points, you're already there. Well, not necessarily, because there are minus points in one category, but you're virtually there, aren't you? Interesting though, why 25%? What happens if the business employs workers who bring in at least 10% of the yearly turnover? Why shouldn't you self-assess and claim 10/25ths of the 35 points you would have got if it was 25%? Certainly worth doing, just in case the revenue come knocking on the door later on, and you can say, well, it's very subjective, this test, and I don't see why my clients shouldn't get some points for the fact that they do employ workers. They don't bring in at least 25% of the turnover, but they do bring in a reasonable percentage. Number 5 is the advertising test. Has the business spent over £1,200 on advertising in the past year? Entertainment, not surprisingly, doesn't count as advertising. If you can say yes to that, 2 points. But what happens if the business has had a remodeled, revamped website costing quite a bit of money, a lot more than £1,200? You might feel, justifiably I would have thought, that's worth more than 2 points. So again, you might want to self-assess a higher figure. Previous PAYE test. During the past year, has the end client engaged you with no major changes to your working arrangements? The only difference being you're now doing the work through a PSC. Not surprisingly, they don't like that, and you score minus 15 points if you have to say yes to that. Number 7, business plan. Does your business have a business plan with a regularly updated cash flow forecast? Does it have a business bank account, identified by the bank as a business account and separate from your personal account? You have to answer yes to both parts of that question, and if you do, you only get 1 point. You may well say, well, hang on a minute, in this particular case, there's a very extensive and elaborate business plan. You may well have created it for the business, and you probably feel it's worth more than 1 point. Again, you might want to argue that. Repair at own expense test. Would the business have to bear the cost of rectifying any mistakes? If you can say yes to that, 4 points. Client risk test. During the past 2 years, has the business been unable to recover payment amounting to more than 10% of yearly turnover? Obviously not a very nice position to be in, but at least you get 10 points for this test. Billing test. Does the business invoice for work carried out before being paid and negotiate payment terms? Yes, if that's the answer, 2 points. Right to substitution test. Does the business have the right to send a substitute? 2 points if you can say yes. And of course, in many cases, the contract will have that. But if the business has actually hired anyone in the previous 2 years to do the work, so it not only has had the right to use a substitute, but it has done so, then you can score 20 points. You're virtually there just on that. So on the risk assessment, when you add those up, less than 10 points high risk, 10 to 20 medium risk, more than 20 low risk. Disappointing, but not surprising, I suppose, that the control test is not included, not even mentioned. Probably because of case law, which suggests it's not necessarily relevant. But you may well be able to argue that the particular type of special service that the client provides through his or her PSC is so specialised that the end client doesn't control anything because they don't know what to do. If they knew what to do, they wouldn't need to hire the PSC in the first place. One would have thought that could be relevant, but the Revenue steadfastly refused to regard that as being appropriate at all. And that's the end of that session.